Hi, this is Keith. I just want to give an update on some experimentation that I've been doing with earnings trades, and I've been trying out some new strategies. And my goal here is, can I build a system around earnings and just sort of have a menu of choices, if you will, like a bunch of trade setups that would work for different scenarios. And then, when you have an earnings event that's coming up, you can sort of pick the scenario that you're comfortable trading, and then build a trade that's very uniquely designed to benefit in that particular scenario. So I'm going to give some examples here of some trades that I put on recently. So I'm recording this on after the market closed on Monday, the 17th of June. So I put on a couple of trades. One I didn't get filled, but I guess I'll follow that one on paper. I did get filled in NFLX, so I'll cover that one. And last week I took some trades in Adobe on paper, and I sort of modeled 3 different scenarios and I basically put those on in paper. But I went through kind of a very the full simulation, if you will, of actually making sure that I'm getting filled, and not just putting on kind of simulated trades, but I'm actually making sure that they are realistic, and that can I enter the trade, and importantly with these ones, can I exit the trade before expiration. So those ones that I did last week in Adobe, they were done on the Option Alpha platform. I've got a bot here. This is just a placeholder, a place to store these trades. So there's no logic or anything in here yet. I may at some point, build the logic to do these trade setups. Although currently the platform doesn't have the ability to do the setup in the way that I've defined it. So I'm using expected move. All of these trades are sort of driven off of expected move. So that's not something you can do sort of programmatically, is to set a strike at the expected move, as an example. So right now it's not possible to automate. Same, even the exits to get out of these positions, it required some sort of manual work to kind of to determine what the right process was to actually get out of the trade. Some actually, maybe it's possible that we could do some exits, because some were easier than others. Again, I'll explain the 3 trades, and we'll go through it. The nice thing too about having it in a bot is you have kind of a record of all the trades that were made, actual timestamps, and you can actually see your fill price, bid ask spread. Even without having any automations, there's a fair amount of information that's stored and logged. We can see that I've got some cancel positions. So I think getting out of one of the positions, it took some time to kind of get filled at a fair price. Get all part of the experiment and all part of the the learning process. And this is something, if I go back and look at this, just kind of see what I've done, that this kind of information is very easily forgotten. So it's kind of nice that you've got it logged here. So let's just look at the 3 positions. So these are 3 not necessarily complementary positions, meaning they're 3 different scenarios that you would probably pick one and trade. Or maybe a combination of a couple of these potentially, but generally you wouldn't put them all 3 on like this. This was really done as a test to say, okay, let's model these 3 scenarios and let's see what the outcome was. And in this case, I did really a lot of analysis leading up to that earnings event. I mean, really the week before was spent really looking at past earnings, looking at expected move, how big of a move had they had previously. And I sort of came to a conclusion of how I wanted to play the trade. But as we got closer to the actual earnings, then I became less comfortable with those decisions that I was making, and I decided to just put all 3 on and just see how they determine, how they work out. So none of these were done in my live account. These are all paper trades. Let's just show you. So I've kind of just captured some screenshots of these actual trades. So these are, again, from the Option Alpha platform, just captured, what the position looked like at trade entry. So this is showing me, what the risk profile looked like when I entered the trade. We can see where the stock was trading around let's say 460 was kind of the price that it was trading at the time that I put these trades on. And I modeled 3 different scenarios. Again, 2 debit spreads, again, on the far left and the far right. These are, I think I was fairly confident in just my review, just based on past moves had all been sort of outside the expected move. And the past moves had been very, very large moves as well. So I was confident that they were going to have a sort of a move, that exceeded the expected move. But also that expected move was, it was really increasing leading up to earnings. And I think it was sort of, anywhere from sort of 7 to 10% was what the expected move was showing, again, depending on which calculation you're using to. And I was pretty confident, yeah, we were going to have, a 10% move, something of that magnitude. So, these probably were the ones that I would have gone with, but I couldn't pick the direction. In hindsight, actually, the way this worked out, it probably would have been fine. Actually, putting both on together might have been a good play, because you can see we've got a 3-to-1 reward to risk ratio here. So, the in this case, actually, the winner here paid for the other losers. So had I done these 3 trades live, I think I'd be up $120 or $140, I think is the current bot P&L that's showing on this particular bot. So again, not bad here. I think I'm a little unhappy with the neutral move. I think that the risk that we took there was just not really worth the reward. So some work to do there. I'm looking at some other different trade types to be able to sort of play a more neutral trade. But I was really pleased with how these outside move trades worked. You can see, when we predicted it right, we were able to get out of that trade, that morning after we got into the trade, right? The morning after earnings. So we're, in this trade for less than a day, and we took down almost 100% profit. Again, we're trading the nearest expiration, so this was, in this case, a 1 DTE trade, and because the earnings announcement was the Thursday prior to that Friday expiration, and it had a very large expected move, so there was a lot of premium there to capture. But in this case, yeah. So the way these debit spreads work is if you're on the right side of it, then that time decay and that implied volatility all works in your favor. If you're on the wrong side of it, like in the case of our bearish trade, you can see even if the price doesn't move, we're on the wrong side, right? So all of that time decay and that implied volatility will come out of that trade pretty much immediately. So in this case, the actual stock moved up significantly. So when I looked at this bearish trade, this long put spread, there's no possible way that I could have exited that trade. So it was showing, the deltas were at like 0 delta, which I've just never seen. Like it didn't even register a delta. It was just so small. So there wouldn't have been any opportunity to exit this trade. And again, with a debit spread, that's fine. We're out of the money. We just let it expire worthless. No need to actually exit this trade, and that's what I did. So we took down 100% loss, just because we were basically forced to hold it to expiration, and that's as expected. That's the way the reward risk ratio is defined here, is that you need to be prepared to take down that 100% loss, again, for that chance of what occurred on the bullish side, which was we got the direction right and the size of the move was really beyond what we were expecting. So it was equally as immediate, right? We took down 100% profit or near 100% profit, and we're actually able to close that position right that morning. So closing it, we could actually look at this position here. I exited the position at 9:37 a.m. So that's like right after the market opened. I think that's the first one I closed, just because I was just wanted to see whether I could get out of it or not, and it didn't require any thinking. It was just basically hit the close button here and put in a price. I think I even forgot to kind of put in a limit price and maybe try to get the best price. I just sort of let it fill at the mid price. I think we can see here bid-ask spread looks pretty wide, so but I think we got a fair price. I don't know how we can see 1950, and we got filled at 1953. So I'm assuming that was the mid price between these two, and maybe I did put in a limit. I don't know. The higher the price, this is a debit spread, so the higher the price is, the better. It would be a better fill. So yeah, so happy with that one. Again, got out of it really quickly. No complexity there and worrying about that one. We could have held that to expiration, but again, when we're in the money on a debit spread like that, when we're profitable, that means we have strikes that are in the money. When we're 100% profitable, again, past this short strike, again, the outermost strike, that means we're in the money on both. Probably we're far enough. I think these were like 97 delta or something like that. So again, really deep in the money. So again, good test to make sure that I could get filled and exit this trade. I mean, the volume was just huge that day. I think that's the biggest volume in this sort of weekly expiration. Is going to be that one, right? It was going to be much higher even than the following day, which would have been expiration day. So that's the benefit too of getting out that next day, is you're going to get out on a day when there's going to be huge volume flowing through these options. Again, a lot of people are doing similar types of trades. They're taking their hedges off, or they're exiting these speculative trades, other option traders like you and I. So yeah, I like those. I like that one. The neutral move, probably, this one was easy, also easy to get out of, but was a little tricky in the fact that, as expected, when the price shot up to the right here, these puts are really far out of the money. Same. I don't know if they were zero delta like the debit spread, but they're far enough out of the money that there's really, no bid. There's just no market for those options. And therefore, it's just not possible to exit this iron condor as a whole position. So what I did was, simulated closing the call side. Again, the call side was the one that was sort of in the money. Again, rather than let it expire and take down a full loss, we were able to recover some profits here. So this one, clicked on the wrong one. Our max loss here would have been 1,158, and we were able to, do a little better than that. We got out of it at $965. And again, that's these other trades here. You can see, actually, I made a mistake. I set it up as a put spread. So I wanted to close the 515, 500 calls. I made a mistake, so I kind of quickly fixed that one. I just overwrote it to kind of take that out, but I think it doesn't show me closing this trade. I just basically put it in and then overwrote it right away, because it's like, okay, that was a mistake. But shows you why you should practice this, because you can get confused. I got confused, put the wrong thing in, and this one here is the actual position. So that's that closing price of $13.07, which I'm just simulating again, buying back the short call and selling the long call that I had. So just basically doing a debit spread trade to kind of simulate the exiting of that credit spread, the call side. So again, all of that, it was helpful to me to just again make sure that I know that there's liquidity in these options to be able to exit to avoid assignment, and to be able to also just visualize, what kind of profit can we expect? Again, we're not holding to expiration. Can we still get close to that 100% profit? And again, because this was a 1 DTE trade in this case, we were closing it with 0 days left to expiration. We were able to get very, very close to that 100% profit, while also recovering some of our max loss on that other trade. So good experience, good learning. I'm going to continue with this, definitely these outside move trades. I attempted to put one on Lennar. I was going to do the bearish outside move in Lennar yesterday, but I just couldn't get the risk reward, and maybe that tells me the outside move, might not be a good play for that particular stock. And in addition to Lennar, I looked for other stocks that have earnings this week, and there's really nothing. So that's why I kind of wanted to see if I could get into Lennar, so I just have something to analyze. But I also put a trade on in Netflix, and that is one that is a sort of pre-earnings play. Netflix has earnings on the 18th, I believe. So they're about 4 weeks away. So we can see that that this rise in implied volatility leading up to earnings, they're just starting to climb now, right? So we're seeing this sort of uptick in implied volatility, and we're predicting the direction is going to follow, past quarters. And where this particular trade that I put on Netflix yesterday looks like this, and it is a call diagonal. Sorry, call calendar. So both the strikes are set at 680, which when I put this trade on, I think it was trading around 674 or so. So a little more than $5 above the market. Not really that relevant here. I mean, we just want, if it moves up a little bit, that's going to put us right in the center of this, of this trade. If the price goes down or goes up, is not really too relevant. This is going to be a longer duration. Again, we've got 4 weeks to earnings. We'll probably be holding this over the next 3 weeks potentially. We will close, the week prior to earnings. So I've modeled here. This is a line here, 7 days to expiration. So, we're looking to collect probably around $1,100 in profit here. But this is going to be a very dynamic trade because it's going to be influenced by implied volatility. And that's different with, your typical sort of, when you have the same expiration, you've got a vertical spread as an example. This risk profile at expiration will always look the same, throughout the entire trade. Here, there's going to be dynamic. So I've marked some points here. I've marked my break evens. I've marked the price where I entered the trade. I've sort of marked sort of the halfway points between those break evens. And I'm using that as reference points so I know that as this risk graph changes throughout the trade, that I know sort of what my original perspective was. And these adjustment points are kind of important, these halfway between. So if the stock were to continue moving even farther, past the center, and let's say when it hits about 762, then I would adjust this. So I would add another calendar spread, and that would sort of, give me more room to the upside and kind of buffer this position. So these are a bit slower working trades. I've kind of avoided them in the past. I think I just didn't really understand them. Now actually spending more time looking at these earnings trades and really kind of digging into what happens with implied volatility and just the shock, that nearest most expiration, and how much implied volatility was baked into those options, and how quickly the implied volatility came out of them. It gave me, this idea of I really need to really spend more time learning these calendars and diagonals. So here we've got our nearest expiration is before earnings. So again, if July 18th is earnings, we've got the Friday before is going to be July 12th, and the Friday after is going to be July 19th. So we're short an option prior to earnings. So that short option is going to have much less implied volatility baked into it. It's going to benefit from time decay. Our long option will be hurt by time decay, but offsetting that is going to be that rise in implied volatility. So this option, very close immediately following earnings, will have that earnings implied volatility. And if it goes as predicted and our implied volatility rises, then that option is going to increase in value, and that's going to be good for this trade. So that's really, we're playing that ratio between in time. So we've got, a difference of time decay between those two, and we've got a difference in implied volatility between those two. So it's sort of a time and volatility based trade. Direction isn't really that important here. And we certainly don't need to pick the direction post earnings, because we're not going to be holding this position past earnings. We're actually going to exit it the week before earnings. So much more simple. So I think I've kind of started the strategy brief on this one. Again, the write up for that Adobe trade, a lot more description in terms of, all the things that I looked at and considered when I was looking at, the earnings piece of it. In this case, it's more just when is earnings and just, making sure that we, I'm giving the understanding as to sort of, why we've set the strikes where we've set it and the price to be sort of in the center of this trade. We're not looking for any really large moves. If there is a really large move, it may be difficult for us to sort of protect against that. But again, if it gradually moves past, our point where this trade will work, we have an adjustment strategy for that. So again, slower moving trade, more adjustment potential. So this one, it's not going to be as exciting to follow as those other ones, but still quite interesting. Okay, so that's a bit of an update in terms of some work that I'm doing around experimenting with earnings trades and trying to build a system to trade earnings on a regular basis. I've got another one that I'm working on, and I'm calling this one my Monday imbalance trade. In this, I've been running for a few months now, and really shows good promise. I'm quite excited about this one. Still, early stages of development. This one, because we're using options volume, that's data that's not available in the automation platform here. So that is done outside of the platform. So it's sort of a manual trade setup similar to the earnings trades that I'm doing. This could be really entirely manually. They're not really that complex to set up. But I have actually automated the trade entry and the sort of trade management. Again, very, very simple. We got a 25% profit target. We're using debit spreads. So that would be 25% of the debit paid. And we're exiting at 10 days if we don't collect profits. Really good win rate here. I think that's the thing I'm sort of most impressed with is just we're taking profits very early. So I think that has a kind of an influence here is the fact that we're collecting a pretty small profit. So it's pretty easy to get a good win rate. But and that's again nice strategy if you can have a regular set of wins. I just don't have enough experience yet to know how these losing trades really work out. We can see we've got some losses that are like 55-70%. So I just need to make sure that I'm comfortable with how the trade is set up before I kind of share this. I don't want to share it as a potential strategy and then once people come to understand it and then realize I've changed all the rules of this particular system. So still quite a bit more work to do on it, but you can see, the positions here, it's opened 4 positions just this past Monday. In this case, a debit spread, similar to those trades we looked at from Adobe, the earnings trades, similar sort of reward risk. We're using a much longer out expiration, so this is going to be the next monthly, right, the July monthly expiration, and about a 3-to-1 risk reward to risk ratio. I think not all of them. I think it's 2-to-1 or higher, but they seem to fall around that sort of 2.5 to 3 is the sort of reward to risk ratio. But again, we're collecting just a small percentage of that potential reward because we want to get out of these trades early and have that capital freed up to put on the next set of trades the following week. So interesting one. Stay tuned for more on this one. I'm calling it the Monday imbalance, and it will be sort of a regular weekly trade setup, and more to come. So hopefully you find this interesting to just see what's in the pipeline for potential strategies to leverage options. I'm going sort of outside lately. A lot of my focus has been on kind of core strategies I've traded for a very long time and spent time to sort of see if I could automate those where possible. Now I'm sort of looking at strategies that I maybe used in the past, but just never traded frequently enough to know whether they really work or not. And now with some automation help, I'm able to kind of run it on a more regular basis and just confirm that I do understand the logic and the rules behind this particular system. Refine it based on kind of what I find and what I think will work best. And hopefully we'll have some new tools to the toolbox, some things to add into our portfolio to to take trades when other trades might not be available, or to just to diversify. Yeah. So stay tuned. I hope you enjoyed this, and good luck with your trading.